We believe that wealth is a journey and that this is your jumpstart to trading success. Hello everyone, and welcome to another edition of the Trader's Mindchat show, where we believe that wealth is a journey and that this is your jumpstart to trading success. I'm Mike.
And I'm Melissa, and we have an incredible show planned for you today. We have Brett Steenbarger on, who is going to be telling us about how you can win the mental battle of your trading. Brett is the author of several trading books, such as The Daily Trading Coach, The Psychology of Trading, and the one that I'm currently reading, Trading Psychology 2.0. They are incredible, and we're so excited to have him on our show today.
Yeah, I can't wait to talk to Brett, and he's also going to be a panelist on the Trader Vault Summit this Friday.
Oh my God, I can't believe it's already here.
Yeah, it's incredible.
So for anybody watching this next week, we'll be able to tell you more about it. But
yeah, that's true, right? Everybody's going to be if you're watching this on YouTube or listening to it on the podcast.
I'm sure we'll have some recaps and highlights to share with you all about this great panel of traders that'll be all in one forum. It's going to be incredible.
Yeah, can't wait.
I know. And so before Brett joins us, we're actually going to be talking a little bit about trading psychology. I am, as many of you know, just starting out as a trader. And reading up on Brett's books, such as Trading Psychology 2.0, I was curious to find out, why do you think most traders don't start with this trading psychology first? Why do they dive right into the technical analysis and the charts? Why don't they do it the way I'm doing it right now?
Yeah, it would be very helpful for traders to start with the psychology, right? Because there's so many, as you're learning and reading now, and for anybody that's been trading for any amount of time, like you guys know, like how many mental hurdles there are in this game, and it would be very helpful to start with mindset. I think the reason why people generally don't is because what's thrown at you by society, like prices, chart action, make money, Lambos, all this stuff, and psychology. What? Like that's not really it's like an afterthought.
That's so interesting, because I think if you're going to be tackling these type of hurdles, that it is so important to go in there with the right mindset to be able to conquer these type of challenges along your way. Because especially for a newbie, you don't really know what to expect.
Oh, well, I mean, like you have the benefit of being a part of the show of and being exposed to this way. Like when you first thought about trading, like were you thinking like, oh, mindset and planning and that kind of thing? Like, or do you think that it would have been more along the lines of what most people tend to fall into?
I think you're right. I think that because I am immersed in it, because I am doing the show with you and I am helping with growing Mara Wealth, I think that I come in with a different perspective. And I was just curious, as I'm on my own trading journey, to see why this isn't part of most curriculums. Like, why is this like an afterthought? Why doesn't this why isn't this more at the forefront of the trading journey?
So there's a couple of things in there. One is the person that's starting their journey on their own, right? The person that's going, here's some stuff on Reddit, on Twitter, StockTwits, wherever, watching CNBC or Fox, if people still do that, and what's there, right? Like, the last bit of news, what's driving the stock up or down, and there's maybe like people throw in the psychology of that, but that's not really what trading mindset is about. Like, that's not what beliefs are about. That's not what talking about your own personal money beliefs and whether you have a growth mindset or not. So I think that there's a group that is trying to do this on their own that might also not have the right idea about just how much trading psychology and mindset is really involved. And then there's the other component, which you alluded to, which is other education being out there, and even in that part of it, mindset being an afterthought. And like I've gone through several courses, like studying, like from O'Neill and like that whole path, right? Even before that, like predating that and going and starting to think about like like I first started the when I first picked up my first trading book, it was one of Jim Cramer's books.
Back in the caveman days.
Yeah, back in the caveman days. Yeah, thank you for that. I appreciate that. But yeah, like thinking back to all those different trading books and sets of books, mindset was hardly ever discussed. It wasn't until I first discovered Van Tharp that I started to hear about mindset and trading psychology, and then getting into Mark Douglas and trading in the zone. And then that led me down a whole different rabbit trail. But for the most part, it's still not a very
It's not a
widely
focal
discussed.
point.
Yeah,
Yeah.
no, it's not a focal point.
And I love that about your elite members, where mindset is a part of the journey. And I think that's why I think that I am coming in with a different perspective, is because I see how you're doing it with the other elite members, where you have the trading mind wheel, you have so many different ways that you can still bring it back to the Matter Mind Shifts guide, which we published back in November. Being able to do these type of exercises and do the beliefs exercises, so that when I go into the next step, which would be to doing more of the technical analysis and understanding the jargon and understanding what I think you mentioned for me to think about setting up an account with Thinkorswim, or coming up with a way that I could just take action. And I think because I have done some of those beliefs exercises already, I realize the importance of not procrastinating, and it is to take action.
Yeah. I'm glad that you brought that up too, because that's the other end of the spectrum, right? The person that wants to try to plan everything, have the perfect plan, and then are afraid of that plan not working, or still afraid to take action. They want perfection, and perfection gets in the way of action, right? Like when we were talking earlier, like the boxing analogy, right? Like if you wanted to be a boxer, you could study boxing, you could hit the pads, but eventually you're going to have to get in the ring, and that means getting punched in the face. And the market will do that to you. It does that to everybody. That's part of the game.
The market has a good
Yeah,
upper hook.
yeah, it has a great right hook, a jab, it knows how to knock people out for sure.
So then, how do you, like, if you want to be prepared for getting knocked down a couple of times, what will help you get back up again?
Be Rocky.
How so?
If we're gonna go with the Rocky analogy, well, one of the things that made him able to get back up was that he built endurance for himself, right? So how do we build endurance for ourselves as traders? Well, one way is going to be with position sizing. I was talking to a few traders this week about different position sizing strategies. When the market is, so there's a few different things to unpack here. There's market conditions. Sometimes the market will favor your condition, like your style, and that'll be time for you to start betting and betting heavier. And so that's what position sizing is. Sometimes the market will be choppy and all over the place and not good for your style, right? So if you're continuing to bet heavy, then you're going to get chopped up, and that's how you get knocked out. So what you would start to do is reduce your size, so that way you could stay in the game longer. It's about longevity. With you approach the market with the mindset of wanting to be in the game for a long time, wanting to have that longevity. And understanding too that that's part of the benefit of longevity, is that it's going to allow you to compound over time, and it's the long-term compounding that allows you to be successful over the long term. If you go in trying to throw the knockout punch, and you're trying to win today, and you're going all in with your account, maybe you win, but all you need is just one counterpunch by the market, and then you're knocked out of the game completely. You don't want that.
Oh, so you want to be like Rocky, where you built that endurance through his workout routine, but everyone knows him climbing up the rocky steps in Philadelphia and like working, as, really as hard as he could to make sure that he could stay in the ring and he could compete.
Yeah, and it wasn't that Rocky never got knocked down, right? He was a everybody loves him for his ability to grind it out, get back up, and fight back. You're going to be able to grind it out and fight back if with a position sizing strategy, right? If he went into the ring and he was trying to knock everybody out with the first punch, and he just gassed himself out in the first or second round, he wouldn't have lasted until 14, 15, however many rounds there were. He was able to last because he understood position sizing from that perspective. Position sizing for his energy. Traders need to understand position sizing for their account.
I love it because it reminds me back when I used to play tennis. I may not have had the fastest or strongest serve, but I could damn well, I damn well had endurance where I was able to continue outlasting my opponents. Where the other person would keep slamming the back at me, but I would just hit it back. They would slam it back toward me. I kept hitting it back, and eventually the other person got tired out. Or maybe their will was lost because they weren't defeating me the way that they had defeated other people in the past.
All right, so let's go a little bit more with this. So you built up your endurance. So there was that part of it, right? Like you built up your endurance, your conditioning for the. And when you were playing the tennis match, were you going all out in the beginning, or were you
I was building on my strategy. Like I was trying to understand what this person's strengths and her weaknesses were, so that I can play to my strengths.
So you knew to kept some in the tank.
Absolutely.
Like you weren't spending all your energy.
No. So I still had some strength as we got into the third set.
That's the same thing with trading, right? So you were trading your energy. You saved your energy for the later round, so that way you could turn it on when the opportunity came. That's what traders need to do. They need to keep their their position sizes small, so that way when the opportunities do start to come and the market starts to work in their favor, then they could turn it on, and then that's when you start to compound very quickly. Then when you start to see market conditions shift, that's when you start to taper back.
It's so interesting. I love these sports analogies because it really does tie it all together. Something that sounds so complex, like a position sizing, and when you put into terms like that, it really does bring it all together and make it easy to understand.
All this stuff is related. You could make analogies for sports, for music, for whatever kind of activity you're doing. You're able to take your strengths and translate them into something that's going to be profitable and help you very much in the market. It's just a matter of asking the right questions and figuring out the way how.
And in terms of endurance, mindset is a huge component of that, where, not only do you need to have physical endurance, but you also have to mental endurance to be able to, like Rocky, get back up, even if all hope was lost, to realize that he can still do it. He had to still get back on his feet.
Right, and you would make fun of me for getting up at 4:30 in the morning, or say that I'm a crazy person, but that's part of why I'm doing that, right?
You're still a crazy person.
yeah. But to build that mental endurance, because when now we're starting to talk about physical fitness, the more physically fit I feel that I am, or even just getting up earlier in the morning, getting a workout in, and doing that meditation, clearing my mind, I feel like I'm ready to go when the moment that the bell rings and the market's open.
Oh my God, I'm so glad you said this, because there's a big difference between how I woke up yesterday versus how I woke up today. So yesterday I woke up late. I was not at my best. I was feeling a little out of it and not, at my full potential. And so just kind of floundered through the day, got certain tasks done, but that was it. Versus, and I made a pact this morning. I was going to wake up early. I was going to do a workout. Even if it's just 15 minutes, I was going to start my day that way. So I woke up, and for me, it was just not even maybe a half hour, 45 minutes earlier than I normally would wake up, and it made such a huge difference. I felt like I had more energy, I was more positive, I felt like I could take on the world. And so really just making a small change like that. Sure I'm not waking up at 4:30 in the morning, more like 6 or 6:15, but it is a big difference for me. So I think for you, just to make a small change like that could make a big difference in how you perform and how you're trading.
Yeah, like the actual time matters less, I feel, than getting that start time, right? Like, so you're able to have a little bit of a head start before you're starting your day. Somebody else that's going to start their day, maybe they start their day at 10 a.m. or 11 a.m. Or something like that. It just back up a couple of hours, give yourself that extra prep time in the morning versus just like kind of rolling out of bed and then just like hitting the charts or trying to
Yeah,
do
then you just
whatever.
feel so stressed too, trying to get everything for our daughter ready for the day, getting ready for school, and you feel like you're rushing. You're on, versus taking that step back and really being able to take care of yourself first.
Yeah, and I think that that's part of it. Like having like a sacred hour for yourself where you're able to get ready, get charged to go. Like that's been a game changer for me, and it sounds like at least day one.
I know, day one. Hopefully, we keep this going, and I can't wait for Brett Steenbarger, who's going to be joining us in right after the quick word from our sponsor to share more game changing mindset tips for you. So stay tuned.
Today's episode is sponsored by the Mara Mindshift Guide, a trading beliefs workbook. Trading is a mental game. This workbook combines 20 years of trading experience with simple, easy to follow exercises to help you manage your mindset and move past limiting beliefs. Get your copy of the Mara Mindshift Guide today on Amazon or at marawealth.com/mindshift. Welcome, everybody, to another edition of the Trader's Mindchat Show. Today, we have Dr. Steenbarger joining us, trading psychologist. He is going to be joining us in just a few moments. He's with another client, like wrapping up a meeting, and is going to be joining us momentarily. The point of this session is for us to primarily answer your questions. So why don't we start by doing this? So that way, when Dr. Steenbarger comes in, we'll be able to get things really rolling. Start typing your questions that you have in right now. We could start discussing what you have now. I'll answer them to the best of my ability, but of course, we'll also get Dr. Steenbarger's insights as well.
Yeah, I'll help field. Hi, everyone. I'm Melissa. I'm going to help field some of those questions. So feel free to plug it either into the chat or the Q&A, and we'll keep track of it for Dr. Steenbarger. And it looks like he's joining us right now.
All right. Awesome. All right. Well, there you go. So type in your questions fast. Here he is.
Yeah, he finally shows up.
The man of the hour.
Yeah, it's been a busy time in the macro world. You know, I work with a number of hedge funds, and we've had some tricky markets the last couple of days, both in stocks, but also in rates. And so it kept me busy. And so I apologize for being a bit late.
No worries at all. I appreciate you being here. I appreciate you taking the time.
Absolutely. Well, it's a difficult time when it's 4:30 in the afternoon and the thing I'm drinking is coffee. So, yeah. So
We're joining you there.
Got it right here.
Yeah. It should be a good barrel-aged bourbon, but okay, there we are. Well, glad to be here, and thank you for hosting me.
Yeah, absolutely. Just everyone that's here that's joining us, just to give you a quick bio of Dr. Steenbarger, and that your resume is so impressive. Like, the more that I learn about you, the more impressed I become. I've been a fan of your work for a while. But Dr. Steenbarger is Clinical Associate Professor of Psychiatry and Behavioral Sciences at SUNY Upstate Medical University in Syracuse, New York. He's the author of The Daily Trading Coach, The Psychology of Trading, Enhancing Trader Performance, Trading Psychology 2.0. Started reading that one as well. Author of Trader Feed blog, and currently writes a peak performance blog for Forbes. Dr. Steenbarger currently consults with a number of hedge funds that you just heard, helps traders and portfolio managers maximize their performance, and is also going to be a panelist at the upcoming Trader Vault Summit this Friday.
True that.
Woohoo!
Yeah. So I do a number of different things. The only thing I don't do is sleep. But it's all good. It's all good. When you love your work, it doesn't really feel like work. And I really enjoy working with traders and helping traders. And hopefully we can do some good things and help some people today.
This is great. While we're waiting for people to be writing in their questions, Dr. Steenbarger, I actually have the first question, which I would love to find out. And hearing about your background, reading your books, I'm just so amazed at how you were able to take your background in psychiatry and then be able to figure out a way that you want to help traders. So how did that correlation happen? Was it something that you always wanted to do, or it just happened magically?
Well, it did sort of come together. I can't take any credit for planning it in advance. I have been interested in financial markets for many, many years, and I started trading when I was in graduate school. So I was getting my degree in clinical psychology, and at the same time, I did trade some markets, and particularly traded individual stocks at that time. And so they were parallel interests and remained parallel interests for many, many years. One of the things I found is that the area that I specialize in psychology, which is called brief therapy, short-term approaches to changing behavior, changing thinking patterns, those techniques were very relevant to the students I worked with when I was running a student counseling service at the medical school. And I found out that those techniques are very helpful with traders and people in financial markets. The same techniques that help people with stress, that help people improve their focus, that help them be more effective in a day-to-day way. Those are research-based, proven techniques, and they work for traders. So I started applying them to traders, and that's how I wrote my first book, The Psychology of Trading. And then a firm in Chicago discovered that book and decided they wanted to hire me. And so I left the ivory tower and went to Chicago to work with market makers in the electronic futures area, where the holding time was something on the order of 6 minutes, average holding time. that was a learning
And so they're
lesson.
long term.
That was long term, yeah, capital gains. But yeah, I mean, because it was such a great learning experience for me, because with that kind of holding period, they're not focusing on fundamentals, because the fundamentals don't change over 6 minutes, and they're not trading off charts. Okay, so you're not trading technically, and you're not trading fundamentally. What the F do you do? And I found out, and obviously they were looking at order flow, and they were looking at much quicker time frames. And it was a great experience, a great education.
Ah, very interesting.
Yeah.
And I didn't know that you were in charge of the student or doing student counseling too. That just reminded me of my days. Well, when I first got started, I was actually doing helpline,
Okay.
like a student helpline where they would first come to us. Well, we would do basic counseling there, and then if it was serious, we would send them upstairs to the counseling center. This was when I was doing my undergrad at Baruch.
Yeah. So I've done student counseling for a number of years. I started out, my first role was at Cornell, a university in Ithaca. And then I went to the medical school and started the first student counseling service there. So I was on the full-time faculty, but I was also running the student counseling service and acting as an associate dean for the medical school. A wonderful experience. And but I loved markets, and so that's how it came together, Melissa. I started using those techniques to help traders, and I used it to help myself as a trader. And that's how it was born.
Wonderful. Thank you.
Yeah, absolutely.
Mike, any other questions to start before we hand it over to the Q&A?
Yes, you had already mentioned adapting to change and this kind of squirrely market that we've been in now for it's been kind of squirrely for me for maybe since the end of February, beginning of March. It's been kind of a choppy environment, and so I wanted to hear, why do you think that it's difficult for uh, even for experienced traders to master this adapting to change?
Yes, yes. And there have been changes. Just think last 2 years, beginning with the whole run up into the beginning of 2020, we had a low VIX grind up bull market, and then all of a sudden COVID hit and volatility just completely changed, liquidity changed in so many markets. And then we, after a big correction, ended up in this bull market mode. But even that has changed, as you see with the VIX coming down and the actual realized volatility in the stock market coming way down, the volume coming way down. So the markets have been changing quite a bit over these last 2 years. One of the things that has been responsible for the recent changes is that the participants in the marketplace have changed. And so the patterns that showed up in past years are not exactly the same patterns that we see now. And so you have two particular groups of new participants. One is very publicized, obviously, the retail traders who are getting involved in single name equities. But then you also have directional macro participants from hedge funds, people who are trading the macro markets, who now suddenly are expressing more of their views through equities and even individual equities. And so with those new participants, you have different patterns that show up. And I think that's been confusing for many traders, particularly developing traders. They may not even be aware that these things are happening. So for example, there's a substantial rotational trade in equities right now, where we see these massive flows rotating from value to momentum and back again, from small caps to large caps. And so the big trades often are one thing versus another thing. It's not just looking at one thing that's going to trend forever. So you have to be aware of those dynamics and observe them unfolding to be able to pounce on the opportunity.
That's interesting. How do you know which like you mentioned that there's new traders coming in, retail and directional macro hedge funds. How do you know who it is that's coming in? I always found that interesting. Like I'm looking at a chart, I'm looking at price and volume. I understand that the market is being moved by the major players, hedge funds, mutual funds, pension funds of the world, but understanding like those smaller groups, how do you know like who is who?
Yeah, it's a great question. And a lot of it sorts out by what they're trading. In other words, a lot of the retail trade is in smaller individual companies. And those are just too small for large institutional participation. When I first started full-time work at a hedge fund, the smallest portfolio size for any trader was $200 million. Well, you can imagine if you're managing north of 200 million, you can't just plunk a big chunk of that money into some small individual stock. The bid offer will explode. And so they really can't participate in that space. So that's more of the retail trade. And the great majority of retail traders are momentum traders. And if you understand momentum patterns, you can profit from what shows up in these smaller individual stocks. And people have done very, very well with that. I work with traders, short-term traders at a firm you probably are aware of, SMB, and they have become very good at finding what they call stocks in play. And what that means is that they have momentum characteristics, volume characteristics, volatility characteristics, often driven recently by these retail traders. Now, on the other hand, the institutions, because they are managing so much more capital, their involvement will show up in terms of large volume. And so that's where you'll see the rotational trade, let's say from the value to the momentum and back again. That's occurring across many different stocks. It's occurring across different sectors. And these are big themes, and there's real volume behind them. So for instance, one of the things I've been doing recently with traders is looking at stocks that have not only the best relative strength, so the ones that are strongest, but the ones with the greatest growth in relative strength. So it's the rate of change in relative strength, and looking at those as momentum opportunities that are funded, so to speak, that are supported by these flows from institutions. And sure enough, you find certain themes that the institutions are pouring money into. Home building and home improvement, for instance, is one of those themes. Consumer discretionary purchases like apparel, that's another one of those themes. And if you look at stocks that specialize in those areas, they've been performing unusually well. And if you can figure out rates of change in relative strength, it tells you how the institutional flows are going. And that can be a profitable trading strategy. But you have to know the dynamics behind the market. You can't just be looking at shapes of bars on a chart.
Yes, absolutely. That
Yeah.
and I think that speaks a lot to developing skills before diving in and just placing trades. Like if you're a new trader, like I think a lot of the retail traders that are new, it just like the first thing. And Melissa and I were talking about this earlier too. Like the first thing that you kind of learn about in trading, like from the retail perspective, is charts and price, and that's what's talked about on TV. That's what's exciting, and you know, psychology and mindset and skill development is in the back seat, unfortunately, and people learn it the hard way.
Yeah, and there is a lot more. I think charts provide information and can be very useful. So, for example, in trading that I do, the charts not only show the ups and downs of the market and the volume, so is volume coming in on these moves, but will look at each trade that is placed. And is that trade occurring at or near the bid price at that time, or is it occurring at or near the offer price at that time? As we all know, markets are auction processes. There are bids and there are offers. Well, where does the trade occur? If it's occurring at the offer price, then the buyer has been willing to pay up. That's an aggressive buyer. If the trade occurs at a bid price, the seller is more aggressive, is willing to take the lower price. Now imagine computing that for every single trade across the entire market. It tells you whether buyers or sellers are getting more aggressive or getting less aggressive. And that's tremendously helpful information in many markets. So it is related to a chart, but it really is going deeper than just looking at price changes.
Very interesting. I see that there's a bunch of people with questions already. Melissa, well, what do we have from the audience? This whole session, I don't want to monopolize the time, so let's see what we've got in.
Okay, great. We have a question from Petra who asks, do you recommend better techniques to improve accepting risk?
Yes. So There are a couple of core challenges for developing traders. The first, I would say, is the challenge of becoming consistent as a trader. In other words, to figure out opportunity, to figure out good risk reward ways of participating in that opportunity and doing that with consistency. And obviously we do that when we're trading small. I happen to also be a fan of trading in simulation mode when first beginning, just as a way of developing that consistency and rule following. It's once we become consistent in our profitability that we start to think about growing our trading, which means, per your question, accepting more risk. And the way you do that is by sizing up all your trades. Once you're consistent, sizing up all your trades by some fixed fraction. Not a huge fraction, because you don't want the trade to feel totally different. And you certainly don't want any single trade or series of trades that go against you to put you in a deep hole. So you gradually grow your risk taking step by step. You get the consistency at the new level of risk taking, and then you're ready for the next level of risk taking, and you get the consistency. So it's a stair-step progression. What I think happens with many developing traders is that they're eager to make a living from their trading or make a fortune for their trading or whatever. And they just size things too large. They take too much risk for the amount of capital that they have, but also for the amount of up and down that they can psychologically sustain. They don't put the consistency first, and that creates all sorts of emotional disruptions. But it's not that they have psychological problems. It's that they're not engaging in the proper stages of development to grow the risk the right way.
What would you say is a maximum size that a beginner should use, and what is the largest size that you've seen a professional use as far as risk?
Well, obviously, for a beginner, the largest size, it has to be relative to one's account size, right? I mean,
Right.
you want people trading on 10, 20x margin. Like, no, not when they're developing, not at all. So the largest size an individual trader takes is relative to their account size. Now, what happens if developing traders do develop well is that at some point they grow, and they don't have any more capital to trade. You know, they have a finite amount. And the answer is not to take more and more and more risk with the same amount of capital. At that point, they really have to attract new capital. And there are a variety of ways of doing that, including joining proprietary trading firms, which can allocate much more capital. And so that becomes a sustainable way, a viable way of growing your trading. You share the profits with the firm, and you get resources that ordinarily individual traders would not get. And you get much more capital, much more capital. So it's not unusual to have proprietary traders who are trading tens of thousands of shares at a time and who are making 7 and even 8 figures in a year. That would not be possible for many individual traders just trading their own accounts. But as far as the largest professional traders, I mean, obviously, asset management firms, pension funds, you know, they're taking positions that are much bigger than even at hedge funds. So that's not trading anymore, that's investing.
Oh, yeah, that's an interesting perspective. I hadn't considered partnering with a prop firm before.
Yes, and it doesn't work for everyone, but most individual traders, it's a very good question about what percentage of return can traders aim to have, and I'll be happy to answer that. That's a good question. Yeah, it's at some point a trader will bump up against limits. Now, they could potentially raise money from friends and family and other sources, But when you join a proprietary trading firm, a good one, and there are some not good ones, by the way,
Mm.
when you, there are a number I've been asked to work at and I decline because they're not, I would not be associated with them. So you have to do your, you have to engage in your due diligence, but the good ones really do provide you with resources, access to different markets, software, speed of execution, plus the human resources. When you're on a trading floor, virtually or live, with many other skilled traders, you're learning from them, you're learning with them. That alone is a really valuable experience. So again, it's not for all people, but for many people, it is a step in their progression if they really want to grow their trading size and grow their income.
Yeah, very interesting.
Yeah. So everything, risk and reward are proportional. And if people are trying to double their money every year, then they're going to, the Sharpe ratios don't grow to the moon. The relationship between average losses and average gains. And so typically if people are shooting for very big gains, they will have periods of big drawdown. What happens in many situations is that traders try for too large an income for the amount of capital that they have. And so what happens is they trade big, and they can make money. But when there is an inevitable series of losing trades, if that's on large size, then they incur what's called a risk of ruin. And that means that they could have a favorable trading pattern, but if they're oversizing, they lose, and suddenly they're in a big hole. If you lose half your capital, you have to double the rest of your money just to get back even. Okay.
Yeah,
And
that's not fun to have to do that.
it's not fun, and it's not a sustainable way psychologically or even financially to run a business. And so many traders, because they don't have enough capital but want to make a lot of money, they're taking too much risk and end up blowing up, not because they're not talented necessarily, but because everyone, even the best professional traders, have series of losing trades, series of losing days, series of losing weeks. It's part of the probabilistic nature of the game.
So when traders are in this drawdown period, well, what kind of advice do you have for them as far as sizing goes?
Yeah, good question. It depends why the drawdown is occurring. Many times drawdowns occur for the reason that we talked about earlier. Markets change. And we're seeing this in stocks currently, where we had been trending higher, and just about all the stocks, all the sectors and indexes were trending higher. And then we got to a period where, okay, well, the large caps are trending higher, but now the small caps aren't, and there are certain sectors that are not participating in the strength. And then most recently, we've seen some risk-off activity. And so the markets change and people will draw down. And so often drawing down on trades that in the past have worked for you, that's information. It's telling you something has changed in the market. And so you do want to pull back your size temporarily, reassess, figure out what's going on in markets, and then get back in. So for instance, when volatility comes out of a market, the patterns that are going to be trading are going to be completely different. You're not going to get those big momentum moves that extend in low volatility markets, just the opposite. You get a lot of the quote unquote mean reversion. You get a lot of the reversals. And so different patterns will work in different markets. And you want to look at the drawdown as information. This is something I could learn from. The environment's changing. How can I adapt? And so that way you're benefiting from the drawdown, even though you lose some money.
That's great.
Well, that happened to me today. Today's market. I was trading today's market in the morning. And so I was looking to buy in the morning. And actually, I did have a long position for a little while. And because we had come down the day before, And so it looked like, we were bouncing in the overnight, and then we sold off early. So that was kind of weird during the European Open. And so it started to stabilize and start to rise. And so I bought, and it just couldn't go up. It couldn't go up. It couldn't go up. It started to reverse. And the thought going through my head is, this shouldn't be happening. If we just made a low, that shouldn't be happening. And so I ended up taking the loss. It was a reasonable loss, not too big. And I flipped the position. And being short today ended up being more helpful. But it was by embracing the drawdown, by embracing the loss and learning from it, that I was able to make the good trade.
Oh, very interesting. It's
You just don't
almost
want to
as
get
if
ego
you're
involved in it. You just don't want to get ego involved. Like, losing trades are part of the business. It's like, I played basketball in school.
right.
You're going to miss some shots. You don't just like go on tilt because you miss a shot. I mean, dude, it happens all the time. It's the best players, the best NBA players. You miss shots and you have some cold days. It happens, but you want to learn from it. And maybe there's something in your game you can work on. And certainly the coach will tell you if you need to work on certain things in your game. But that's why I tell traders, you want a positive learning P&L. Even when you don't have a positive financial P&L, you always want to have a positive learning P&L so that you're getting something out of your losses. You're
I love that.
you're paying tuition. You might as well get some education for your effing money.
That's great.
Yeah, that's going in the highlights for sure.
Okay, all
learning
right.
P&L.
We'll put that in the highlights. Yeah.
This is great because I feel like the fear of losing, this is a problem for a lot of traders. And Don actually asked this question. He says he struggled terribly to overcome the fear of losing. Because of that, he trades laughably small, and he does miss many, many trades by hesitating. Do you have any advice for traders like him?
Yeah. You want to look at the patterns of winning and losing in your trading. In other words, you want to study how the market moves and what patterns you see in markets that go up, markets that go down, and you're going to predicate your trading, base your trading on those patterns. And some of your trades are going to work and some won't work, and you want to study what works and learn from that just as much as you study what didn't work and what could be improved. And so in the beginning, it's not about the wins and losses. It's about understanding this market that you're trading and the patterns that show up and making decisions the right way with those patterns. And like I said, that can start in simulation. That can start when you're trading very small. But that's what produces the consistency. And if you're following those patterns, again, and they're not working out, then that's a really good indication that a market has changed and you need to go back to the drawing board, the learning board. So again, the losses are information. Sometimes they're information about mistakes you're making. You're trying to get too big, you're trying to get too aggressive, you're chasing some things. Those can happen for emotional reasons. But you want to learn what did I do wrong? What could I do better? But it helps. It helps if the losses are sustainable. If they're not big losses, then you don't get so wrapped up in them. When people are dating, I'm changing the topic. When people are dating, like, I'm a big believer in go on lots and lots of first dates and not too many second dates. So The majority of your first dates are going to be quote unquote failures, losses. Fine. You only have to find the one right person. But you don't take it personally. It's like you're looking for the right fit. And so, you meet many people and many people and many people, and eventually probabilities catch up to you and you meet the right person. That's how you do dating. Trading is a little bit similar, that you try lots and lots of different things. You make sure you don't take big losses. You don't overcommit to any particular idea and so forth in the beginning. And you're going to take losses, but you keep them small, or non-existent if you're trading in simulation in the beginning, and then you start to make the bigger commitments to the things that work for you.
And understand too that every trade eventually ends in divorce, right? Every trade ends.
Every trade ends, and you may end the trade and not necessarily divorce the idea. And so, for instance, I may be long the stock market because I think the economy coming out of COVID is growing and that there's an unusual amount of fiscal stimulus on top of a Federal Reserve that is keeping monetary policy easy, and that's conducive to higher equity prices. But that doesn't mean that I'm going to trade long the market at every point. And so, for instance, recently, like I said, with the trade that didn't work for me today, the breadth of the market has been declining, and we're getting some natural rotation away from stocks. So you can divorce the trade, you could end the trade, but the idea may continue.
That's freaking brilliant. I'm going to go back and rewatch this a few times and get some more nuggets out of what you just said. And I encourage everybody else to do the same. Melissa, well, what else do we got?
Okay, this is the question that was referred to a little bit earlier by Alexander, which is what's a good percentage return traders can aim to have, and what's a great return traders can aim for that's achievable?
Yeah, again, it's going to, the drawdown that you end up taking will be proportional to the returns that you try to make. And so, if you're trying to double your money, at some point in time, you're going to lose half your capital. It's not like you're going to find the Holy Grail where you can double your money all the time and every other person in the world of finance hasn't figured that out. Like, no, that's not going to happen. So again, Sharpe ratios don't grow to the moon. And so you have to target returns that are sustainable. If you were to make good risk-adjusted returns of 10% a year, when I say risk-adjusted returns, I mean you're not taking much in the way of drawdown. You have a good Sharpe ratio. So if you're making 10% a year with a high Sharpe, and especially if you're not particularly correlated to other traders, you will always get a job at a large institutional fund. Like anyone with that track record, I could find them a job probably in a day or two. So 10%, I mean, that's not so eye-popping, seemingly. Now, obviously, individual traders, day traders use leverage and try to target larger returns than that. But what you find is that they're making a lot of money by trading a large amount of capital. They're not making a lot of money by targeting phenomenal returns on a small amount of capital.
Okay, we have another question for day traders. What's the best way to trade? In this case, it's a question about overtrading, how to prevent overtrading. Do you have any advice for someone who is overtrading in the market?
Yeah. So an analogy I use, because I teach at a medical school, is learning a performance skill like surgery. I work with medical students who learn to become surgeons. Well, how many developing surgeons overcut? How many developing surgeons go on tilt and start cutting in ways that are not called for by the patient's treatment plan? That happens no times, zero.
Yeah, I was going to say, I hope the answer is zero.
I was hoping that too.
Yeah, but that's the whole point. Well, why would that be? I would say doing surgery is more stressful than putting on trades. I mean, it really could be life or death. So why don't they go on tilt? Why don't they over operate? The reason is because they've gone through a disciplined training process. And they have practiced many, many, many times, and they've observed successful surgeons many, many, many times before they ever undertake even an assistant role in the operating room. And that disciplined learning process starts by learning anatomy and physiology, and then it moves to learning to make incisions, but you do it on a cadaver or you do it on a model. You don't do it on live patients. There's lots of practice, lots of observation, lots of Q&A, lots of learning before they ever take risk. And that's what many traders don't do. They end up wanting to take risk. They take a seminar and then they want to trade, or they read a book and they want to trade. And they're not prepared, and they don't know how to handle situations. They haven't observed enough. They haven't gotten the mentoring that's necessary. And so they overreact, and that's what causes the overtrading, and that's what causes the going on tilt. And the answer obviously is not to consult a psychologist. The answer is to get proper training and experience in learning markets.
It's kind of like if you decided to set up a shop on the street corner that said free surgery, or
Right. Actually, I like the stand on the street where they market self-help surgery. Where you could do your own surgeries, and the name I came up for it was Suture Self.
Suture Self. Oh my God.
I thought that's pretty good. Anyway, yeah, so that's my surgical joke for the day.
Oh my God. Having been in the medical community too, I really appreciate that one.
Oh, here's a good one. I always hear that to buy stocks into strength. So with small caps beaten down, do you think hedge funds are not buying it as a bargain? Some say buy cheap and sell high. What's the method that you suggest?
Yeah, very good question. And obviously there are different trading styles, and hedge funds don't trade for the most part, they invest. And so investing is different than trading. And many investors are quote unquote value investors. And so they are trying to buy cheap. They're buying value and hoping that value appreciates over time. But there's a difference between the investment thesis, which is this is an undervalued company. This is a company that's going to be growing in coming years, and how you trade that thesis. And so, for instance, you may have an idea that you want to be long the stock of a company because you think it'll be growing, but you're going to wait for some signs of strength in the shorter term to actually implement your trade, to actually enter the position. And so if you have evidence that the stock is making a series of higher lows, so every time it retraces, it's making a low point at a higher price level, well, that's the very definition of an uptrend on the short time frame, and you may use that information to help you execute the trade that's based on a value proposition. Obviously, short-term traders, day traders, they may trade different ideas. You might have a stock that's trading in a narrow range and then breaks out of that range on high volume, which shows that there's a lot of new bullish participation in that stock. And you may see that as a momentum opportunity. And so you're going to, as the questioner asked, you're going to buy strength. There are different styles, different patterns that show up in markets.
Okay, wonderful. This question is from an attendee who asks, can you speak to the trade that did not work for you today, and what did you learn from this trade?
Oh, the trade that didn't work for me?
Mm-hmm.
Yeah, I learned that I was wrong. No, but that's seriously the stock market has been making a series of higher lows, and we came down on Monday, And so I saw that potentially as a low that would be a good place to buy. I bought in the overall market, the stock index, I bought late in the day. And sure enough, in the overnight session, it went higher and it was looking good. And then London opens up, Europe opens up, DAX comes down in Germany, and the position that had been working all of a sudden reverses. And it reverses with some real volatility. It was a meaningful reversal. And that immediately told me the character of the market had changed, that this bounce should have continued. It didn't. It told me I'm wrong, and that new flows were coming into the market that were selling. And so I waited for a bounce and I went in as a seller. So it told me I'm wrong. It told me that the character of the market had changed. Why had the market changed? What's leading to the selling? I think there was some extreme positioning in certain asset classes. A lot of people long stocks, a lot of people short interest rates, and there's a fair amount of concern about the number and types of COVID cases in India. And that's leading to some global macro concern. What's happening in India is not normal. If you look at the number of cases and the exponential rise in them, it's different than we've seen in other spikes in other countries.
That's interesting to consider. Part of what you were saying too, I'm curious to get your perspective on this. So when traders have a plan that they like, a good plan is going to have a point where you're wrong and give yourself multiple ways to exit a trade. At what point do you think that it is appropriate then to call an audible to the original plan? Right? Like, so this morning, for example, if a stop loss or a trailing stop or something like that was part of the plan to help get you out of the trade. Now I feel like I'm starting to put my own thoughts into yours, but if that would have gotten you out of the trade, but then you start to see something else manifesting in the market, just like, oh, you know what, I don't really like this. Maybe I should take the trade off a little bit early versus allowing the trade to play itself out, because none of us can predict the future.
Yeah, it depends. If you're going to call an audible, it's because something is happening that's a game changer. And you want to be able to distinguish what's a game changer from what's just a random occurrence. So let's say I'm long stocks and a certain news item comes out that might be quite bearish. Or let's say an asset class that is correlated with stocks suddenly encounters selling. That could be a game changer, maybe not for the stock market as a whole, but certainly for that particular trade. One of the things that leads me to call an audible, for example, is if what I'm trading is making new highs and a lot of other stuff around it that should be correlated cannot make new highs. So you're seeing weak breadth on a short time frame. Well, there's a saying, a rising tide lifts all ships. If all the ships aren't rising, then I'm going to question the tide. And so if my stock or my stock index is making new highs, but lots of stuff is not, perhaps this is not such a strong trend, and I'm much more likely to take profits proactively. And that might be calling an audible.
That another brilliant, I'm thrilled to have, I feel like I'm improving dramatically. I'm pretty sure everybody else in the room is too.
Mm-hmm. Great.
Oh, I just love hearing that. Even, I'm sure if there's any other beginner traders in the room right now, that even experts have challenges and they face loss and they face this on a daily basis. And it sounds like as you continue to improve, it's still going to be like, whether it is your own mindset, you have to continue to grow along with your trading.
Yeah, absolutely. There's a saying in Silicon Valley, fail fast. And I think that's what you want to do in trading. If you're going to be wrong, then, be wrong in planned ways, lose in planned ways. You don't let losses multiply. And yes, it's a probabilistic game. The best traders I work with, have losing trades, losing days, losing weeks, losing months. And I certainly have that in my own trading. But the idea is to know when you're wrong and to be able to accept that, learn from it, and move forward.
Yeah, I love that there's no ceiling to this game either. I've been in the trading now for 22 years. The first 10 were a nightmare, but there's really is like no ceiling to performance and personal improvement.
Yeah, I'm glad you mentioned that. One of the things I do emphasize in my work with traders and in many talks I give is that a great technique or a great contributor to having a positive psychology is having things in your life that are more important to you than P&L.
Mm.
And it's not to say that trading isn't important or shouldn't be important, but we want a diversified life, just like we would want to have a diversified investment portfolio. You're not putting all your chips in all at once. You're not, you're not all in that respect. And so if you have personal relationships that are important to you, if you have a community that's important to you, personal interests that are important to you. I have a wife of 37 years. I have 5 children, 7 grandchildren, 4 rescue cats.
Oh, wow.
I work multiple jobs right now. I'm working 3 different jobs, not just working with traders. I still teach at the medical school, and I work with students in another job. And so I have many different roles and responsibilities and many different outlets. I have spiritual interests and have written a book on my blog site about that, the spirituality of trading, which is an interesting topic. So you have all these interests and you have all these activities. And if I have a losing day in the market, am I really going to overreact? I mean, big effing deal. I'm going to have a happy and successful life, whether I make money or don't make money on a particular day or particular week. It puts everything into perspective. And so I worry about traders who put all their energy into trading and they say, oh, I've got such a passion for markets and that's all I do. I'm working day and night. And that's a formula for too much stress. You're putting all your eggs in one performance basket. I think having a diversified life, having a happy and fulfilling life helps you be a better trader.
It's beautiful advice. Thank you for sharing that.
Oh,
I know
absolutely.
we have a hard stop at 5:30, so I think we'll maybe have time for 1 to 2 more questions.
Great.
So this one is from Matija. I'm sorry if I said your name wrong. She says she's a big fan. She identified her biggest problem as a developing trader is patience. Patience with entry, and even more importantly, patience with letting the trade play out, taking partial profit too early, and they end up with a very small position size. How can this person and other traders train to improve on patience?
Yeah, so patience on the entry often is really charting out specifically what you need to see to have a good entry. It's an interesting question about coach traders. You want to, it's like you find a setup for your trade idea, but you want a setup for what is a good entry for that trade idea. So for example, I won't enter a trade in the S&P until I see selling in the NYSE tick, which is the number of stocks trading on down ticks versus up ticks. I see the tick going negative, and I see selling, 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 and the market can't make a new low. And that tells me the sellers are trapped. The sellers can't push the market lower. So I want to use that as a trigger to enter my trade. And I've diagrammed that and I've studied that, and that allows me to get good risk reward on the entries. And so that ends up being really helpful. The issue of taking partial profits, I think, can be a good strategy, especially if you have a lower volatility market. Taking profits quickly on a portion of the position and then letting another portion run to a more distant target can make sense. In a lower volatility market, you'll get more reversals. So at least if you've taken profits on a portion of the position, then if the whole thing reverses, you still have some profit in the trade. You haven't round tripped it. So I think that can be a good practice. You just want to grow your size in doing that so that the piece that you leave on is meaningful.
Okay, great. And I guess we'll just tackle that last one from Julison, and I'll hand it back over to you, Mike. So our coach traders specialize in specific strategies, operations in financial market, like options, stocks, commodities, etc., or he or she can help in mental side regardless of the strategy or operations?
It's a great question. It's a really, really good question. Okay, so I have a bias here, and so I'm going to own that bias right away. So I don't ice skate, okay? How good of a coach would I be as an ice skating coach? Like, I don't even know what the F I would say to people, like jump higher or spin faster. What would they say? Well, what I would say is just a lot of silly generalities like, oh, you have to be more focused on what you're doing and whatever. So to be a good coach in any sport, you have to know the sport. You don't necessarily have to be a star player, but to be a good basketball coach, you have to know basketball. You have to know strategies in basketball. What a zone defense is, what a man-to-man defense is. If you're a football coach, you have to know defensive alignments. You have to know offensive plays. Which plays do you run against different defenses? Like, you got to know that stuff. So you have to be somewhat of an expert in the content. You have to be knowledgeable about the content to be a good coach. You can't just say, well, I work on mental strategies, and you have no clue what people are doing if they're trading options, or if they're trading relative value in rates markets, or if they're trading, different currency pairs around the world. You do have to know what they're doing. And so many people try to set themselves up as coaches and don't really understand trading. And that's a real limitation.
Okay, thank you. So many great questions. So sorry we couldn't get to everyone's today, but I'm going to hand this back over to Mike.
Well, thank you, Melissa.
Thank you very much. We appreciate you being here and taking the time. Do you have, before people leave, what's some of the best ways to get in touch with you, learn more information about you? We'll have all of your books and everything linked in the show, but where can people find you?
So a great way to find out about anything I've written on topics is just Google Trader Feed, TraderFeed, and the topic you're interested in. So you could Google Trader Feed and performance anxiety. And you'll see everything that I've written on my blog on that topic. I also, on the Forbes site, if you Google Forbes Brett Steenbarger, you'll see a list of all the performance articles I've written. And on my blog, I do have that free book that's on a blog platform called Radical Renewal, which is about the spirituality of trading. And I also have links to my books. I don't do coaching with individual traders. And so, unfortunately, I can't offer advice to people. My work is solely limited to institutions like proprietary trading firms, asset management firms, hedge funds, pension funds, that type of thing. Investment banks. Yeah, that's the stuff I do.
And I do have one more question for you. I've asked this of every person that's come on the show that's also going to be a part of the Trader Vault. Jason had said that he sees us as the Avengers of trading. Who is your favorite Avenger and why?
This is the toughest question all day.
It really is. It really is. And I really don't mean to be snarky. I don't watch television. I work from 4 in the morning when European markets open into the evening. I work with traders in Hong Kong. I wouldn't know the Avengers from a hole in the wall.
All right.
And it's just not on my radar. So I know of the Avengers. I know what he's saying, and it's a nice idea. But anyway, yeah, I'm living in a different universe.
All right, maybe the DC universe.
Right. Yes.
This has been so helpful, Dr. Steenbarger. Thank you so much for being on the Trader's Mindchat show. For anybody who is joining today, if you want a copy or to be able to view this at a later date, we will have this up on our YouTube channel, the Mara Welch YouTube channel next week, and you can get more of Dr. Steenbarger there. And I know I took plenty of notes today, so I can't wait to dive deep into this for the highlights. And Mike's showing his notes too.
Yeah.
Well, thank you very much, Melissa, Mike. You've been great hosts, and I appreciate the opportunity to speak with folks and want to wish everyone well in these challenging markets.
My goodness, Dr. Brett Steenbarger brought the thunder.
He did. Maybe he's going to be Thor. Maybe we'll make him Thor for the Avengers.
He might be. He might be. I don't think anybody's taken that one yet. So yeah, Thor. Well, what do you think, Brett? Let us know.
Put it in the comments. But wow, so many gems, such a wealth of knowledge and information. It really helps you think differently about the markets. And I love that. It's a fresh new perspective about psychology, being first in the trading world versus starting with something else.
Yeah, and I love how there was something for everybody in there. Whether you are experienced, you have 20 plus years of experience like I do, you're starting out like you do. There was like so many gems in this episode.
I know, and especially from like a beginner perspective, I loved when he said the stair-step progression to risk. Like when you're afraid to take that risk management, he's saying that start in simulation mode. You don't have to go right in, start an account, and start putting your own money in before you're even prepared to know what you're doing. So that makes the managing risk a lot easier, where you're doing a simulation mode, and then like you kind of like take another stair step. Then you're like, okay, then maybe I'll start a little small in my account. I'm getting a little bit more confidence and preparing myself better, and then take another step, and then take another step. And I just love that. It just really makes you say like you don't have to go all in with all your money when you're just starting out. What did you get out of it?
One of the big things was about calling audibles, and I think that there's often when traders, many experienced traders, they'll write out a game plan and then they have trouble following that game plan, and they end up calling an audible. So, well, when is it appropriate to call an audible? When there's a game changer, right? So I think that it would be extremely beneficial to write out all the different things that you would consider game changers ahead of time, so that way you've already thought through that process, and it's just like, oh, is this a game changer? Actually, no, I think I'll stick with my plan, and it makes sticking to the plan that much easier.
Absolutely. I love that. And I also love when he said the whole self-help surgery. I thought that was hysterical. Like, you're not going to go to some sort of vendor on the side of the road that's selling self-help surgery. Just like, you have to undergo a disciplined learning process, similar to how a surgeon would start out, that they're going through a rigorous training where they're not just going and starting surgery on day 2. Like, they have to learn about the anatomy of the body. They have to they first practice on a cadaver, and then they're watching other people during the surgery. And so it's not like they're just jumping from A to Z. So they have a detailed process. Most
Right.
traders don't do this. And so I think that this is a great way to kind of say, like, wait, what is our disciplined learning process as a trader?
And there was so many gems in this. We'd love to hear what some of your favorite parts are. You could, if you're watching this on YouTube, drop it down in the comments below. If you're listening to it on the podcast, you're listening to it on Anchor, Spotify, Apple, all the other ones, just send us an email, Mike@MaraWealth, or you could go to MaraWealth.com and let us know there.
Yeah, we'd love to hear from you. And don't forget to subscribe. And we can't wait to see you for future episodes.
Awesome. So we hope that you got a lot out of this episode. Now take it and run with it.
See you next time. Bye.
Take care.